Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. Global markets are very much focused on the Federal Reserve. The Fed's newest governor, Stephen Miron, was sworn in Tuesday just in time for this critical two-day policy meeting. Nominated by President Trump, Miron is the chair of the White House Council of Economic Advisors. Now, he's taken leave from that role, but he hasn't resigned. Here's Bloomberg's Michael McKee.
We're not going to feel the imprint of his presence either, except that he might dissent if the Fed does a 25 basis point cut, and he might call for a 50 basis point cut, because that seems to be the reason he's been sent over to the Fed by Donald Trump.
In a moment or two, we'll get the views of Sean Darby. He is managing director at Mizuho Securities Asia, but we begin here in the States. Joining me now is Bob Dahl. He is president, CEO, also the CIO at Crossmark Investments. Bob, thank you so much for making time to chat with me. Are you in the camp for a 25 basis point rate cut?
I am, as most of the rest of the world is, Doug. A very important meeting because of what's going to be said around it. I think much less about what the decision is. People are expecting 25.
There has been some speculation, maybe you've heard of it, kind of the sell the news theme after the Fed's decision, maybe a gap down for the equity market, given the fact that this rate cut is pretty much widely priced in, as you just said.
Yeah, I think that a lot will depend on what the verbiage is around it. In particular, what does the chairman say in the press conference that follows? If he indicates that there are more coming, that is more cuts, the market might like that. If he says we're really worried about inflation, just going to have to watch the data, the market may not particularly take a shine on that. So a lot will depend on what is said in the conference.
So I saw the latest survey from Bank of America, fund manager survey, net 28% still overweight equities. With what we're talking about in terms of Fed policy, the likelihood for subsequent rate cuts, are you still constructive on stocks?
Reasonably so. I've sort of hedged by saying we are in a high risk bull market. Bull market obviously means the path of least resistance is up, Doug, but the high risk means, but be careful. Stocks are very expensive relative to history. And, we have some question marks. We just talked about the question mark around the jobs market, a little bit about inflation. It's not anywhere near the Fed's 2% target. So a lot could go wrong, but till now the market has said earnings are fine. Leave me alone with all that other disturbing and a set of issues that don't make a difference, quote unquote.
So, Bob, if you do have questions, I'm curious about the strategy that you're using. Are you taking money off the table where it relates to equities, maybe? And you looking at the bond market at all?
So yes, we have some money in the bond market. Now that has run as well, as you know, with the 10-year Treasury yield approaching 4% from being higher not that long ago. So bonds are not all that attractive either. Now, I'll say this. If the Fed, or when the Fed lowers rates, and if they hint at more, shorter maturities probably will do well as interest rates come down the front end of the curve. Out past 10 years, they may worry about inflation if the Fed is threatening to reduce rates more. So we could end up with a steeper yield curve, if you will.
So I know that a lot of the expectations here on this rate cut are perhaps founded on this notion that we have seen deterioration in the labor market. But if you look at the day's economic news today, the retail sales number, that was pretty upbeat. I mean, a rate of 0.6% in August. And if you look at the control group sales, that's obviously a part of the calculation for GDP. We saw an increase of 0.7%. That suggests a pretty healthy quarter. So net, I mean, the American economy looks like it's still pretty strong right now.
It certainly does. The contemporaneous numbers are generally been pretty good. And of course, earnings for the first two quarters of the year were brilliant. And many are expecting that again in the third quarter. The question is, will jobs being weaker, will inflation being higher get in the way of all that? So far, so good. But we'll have to watch both of those carefully. And that's, of course, the balancing act that the Fed has. Their job's never easy, but they're between a rock and a hard place. Labor market seems to be weakening. Inflation seems to be firm. What are they going to do?
When it comes to a lot of the power that we have seen in the equity market, you have to look no further than artificial intelligence. That trade, mega cap tech, has been a big theme for much of the year. How are you feeling about that right now?
Constructive. It's for real. AI is for real. Now, that's come into the price of stocks in a pretty big way. So we could debate, is it too much too soon? Often Wall Street gets a hold of these new, if I can call AI new concepts, and they get it right in terms of direction, but they overdo it and do it too quickly. Are we going to have a sell-off? Time will tell. Obviously, in the first quarter, the so-called Mag 7 and other AI stocks struggled, but they came back with a vengeance off those April lows.
So we're talking about the TikTok deal earlier. It looks like we've got a new entity here in the U.S. that will take ownership of the U.S. assets of that platform. So maybe a little bit of positivity in U.S.-China trade relations. We also have news coming out of the UK that the British government essentially is accepting the fact that this 25% U.S. tariff on British steel will remain in place. Now, I know that the Prime Minister was hoping to address that, maybe getting the levy removed outright. How do you understand U.S. trade relations globally right now? If we can focus a little bit about China, maybe to a lesser extent Europe, and include the UK in that.
So I would say the trade relationships and the tariff implementations have gone generally better than many of us feared. Now, China, we're not done there. We got to dot some I's, cross some T's, and we're not ready to do that yet. A lot of basics to be decided. Getting China done is going to be really important. Europe is, they've groused along the way, but they've gone along with it. The UK, the same. Look, you wonder at any point in time, will one of these countries or a block of them saying, the deal is not a good deal for us. We're not going to observe it anymore. What are the consequences of that? We're not sure. So far, so good, but a lot of tough days coming.
I'm wondering whether you're finding opportunity offshore right now in the midst of everything that we're talking about that's tariff related, where other jurisdictions are involved and maybe a little bit of question as to whether or not that would be a headwind for some of those economies.
Certainly, it will be a headwind. There's no question about it for most of them. And yet, we think a lot of that is in the price of those stocks. As you know, generally speaking, non-U.S. markets are a lot less expensive than U.S. markets, and for some good reasons. But we find a lot of Americans have almost nothing outside the U.S., and they're looking there to do some buying. So I think that will create some upward momentum over the months to come in non-U.S. markets.
One of the big reversals that we have seen this year has been in the U.S. dollar, and there was some weakness in the New York session. I think the Bloomberg Dollar Spot Index was down by more than 0.5%. That's a pretty big move. How are you feeling about the dollar and the path that it is on right now?
So a bit oversold at the moment, and as you probably know, the consensus almost to a man and a woman is a long-term negative on the dollar. I find myself there too, particularly as interest rates in the U.S. come down, perhaps more than outside the U.S. As rates come down, that usually hurts a currency. So watch it carefully, but I would not be surprised to see some more weakness in the months to come. So
you mentioned a moment ago that there are opportunities that you are seeing in the bond market right now, and I'm wondering what part of the curve interests you the most?
The shorter end of the curve, call it 2 to 5 years, maybe out to 8, but certainly not past 10 because of that concern we have about steepening and about the fact that the inflation rate seems to be ticking higher, not lower.
Bob, we'll leave it there. Thank you so very much. Bob Dahl, he is president, CEO, also the CIO at Crossmark Investments, joining us here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. Equity markets across the Asia Pacific are showing some weakness after a down day in the U.S., where the S&P 500 and the Nasdaq Composite slipped from record highs. American markets appear to refrain from making any big bets in front of tomorrow's Fed decision on interest rates. Let's get the views now of Sean Darby. He is managing director at Mizuho Securities Asia. He spoke earlier with Bloomberg TV host Shery and Annabelle Droulers on the Asia trade.
I think it's interesting because, the stage sort of seems set for this cut, and it's that big focus on the projections. Now you've got Stephen Myron in there as well. It's going to be that big focus on the dissenters as well, the ones that are agitating for larger cuts. And again, it just seems like this is all kind of positive for equities.
Well, it is really. I mean, we're in one big reflation trade and oil prices remain low. The dollar's dropped nearly 12% from its peak. You've got steep yield curves, particularly in the United States, and you've got this on-running loosening of financial conditions where credit spreads are also very tight. So almost anything that you throw at the equity markets, it's bouncing back. I think the irony may be is that 3 to 4 months from now, as we go into the year end, the economic data points are going to come really important, because this has all got to have some follow through later on in terms of some earnings changes. And although economic forecasts have been marginally upgraded, it's nowhere near enough to sort of meet the expectations that the equity markets have priced in over the last 3 to 4 months.
So then how long does the good run continue, and when does that sort of reality check set in? I mean, markets move ahead of those economic projections or results.
Well, the paradox is that the bond market's going to do a lot of the work for you. If we do get a real slowdown and not a soft landing, then that's going to be lower bond yields, bad for equities. If we're going to get a re-acceleration of growth, which is what our case is, then bond yields will sell off, and that's going to be very difficult for equity markets in terms of valuations. So as the further we go on this rally, the narrower the ability for equity markets to manage around bond yields, I think, is going to be the main constraint.
Despite the fact that we continue to see a solid economy, Sean, especially in the U.S., earnings estimates continue to move higher, and we just saw consumer spending also remaining strong.
Well, that's really the paradox. It's not just the United States seeing these better earnings numbers. Most of the equity markets we cover at the moment, earnings revisions have been actually quite positive over the last 3 months. So you are getting some upgrades, which is allowing this rally to continue. I think one very important point is that for the best part of the last 18 to 24 months, bonds and equities have been positively correlated, the prices, which is very, sort of rare in the last 20 years. And we're going back to a period where bond and equity prices are negatively correlated, which is what I think is really producing this big tailwind for equity markets. So maybe any change in the inflation data might actually upset that apple cart going forward. But you're right, earnings numbers have been relatively better than expected, and certainly when we look at the Nasdaq earnings revisions, they're melting up at the moment. So again, I think investors are really more focused on the fact that there are these big growth areas, and that's really what's driving the rally. Bond yields, I think, are going to be perhaps a later story, but they're actually producing a fantastic tailwind for equity markets.
How much of that dynamic with bond yields is at play here in the Japanese market that has also other idiosyncratic stories like the BOJ normalizing and hiking rates, and at the same time we're seeing this uncertainty over the LDP leadership election?
Well, I think the way to describe Japanese monetary policy is that it's ultra loose at the moment. Real interest rates are very deeply negative. So the economy and the equity market are responding to that. In fact, if you look at the best part of the JGB yield curve up to 10 years, that whole yield curve is in negative real rate. So highly stimulative, even without any other additions to it. I think for Japan, the story really is that you're going to get a very strong set of nominal GDP numbers, and that's going to continue to uplift earnings. And if you look at the small cap index in Japan, as well as looking at the Russell, when you get these big bouts of nominal GDP growth, it's small cap stocks that tend to do very well, and Japan is no different from that.
One of the names that's doing well so far is at the Open in Tokyo is Tokyo Electron. They've had an upgrade from Bank of America. It's still that broader tech story, the resilience we see in terms of AI spending as well. This is very much the mainstream view. So how do you find value right now?
Well, I think the mainstream view is, as you said, it's very much on the AI spending by the 4 big mega tech. What we're finding is actually that spending is broadening out to everything from computer peripherals all the way through the supply chain. So the real story maybe is that what you saw from Oracle last week, which was a sort of a non-AI player in the sense that it wasn't part of the megatech story, is probably going to get replicated in large parts of the Nasdaq. So from our point of view, you should have seen with some of these AI stocks like NVIDIA, that story seems to be well priced in. It's going to be all of the relative other part of the chain of tech spending that's actually going to do quite well. And we think, again, this has probably got a 3 to 6 to 9 month story. A lot of it focused on the tax, the tax benefits from the depreciation changes from one big bill act 3 months ago.
That certainly has played into it. What about then for Korea? Because I know you've just upgraded your view on that. Is that the tech story, or is that sort of also the value up program as well starting to take more effect and more investors also paying attention to it?
I think the value up story has been one part of the move. I think the economic story has been that the semiconductor companies in Korea, as you've seen in elsewhere, has got pricing power. This is an industry that very, very rarely you see companies being able to raise prices, and flash and memory prices have been surging. So for the big constituents in the KOSPI, that's been a very big boost. The second is that following the elections now, you've got consumer confidence starting to improve, and we've actually seen retail sales numbers, both by value and volume, all picking up. So stories outside of the tech sector in Korea are also got some sort of franchise value. So I think the KOSPI, as you've seen with most of the North Asian markets at the moment, is got, still got room to rally.
That's Sean Darby. He's managing director of Mizuho Securities Asia, in conversation with Bloomberg TV host Shery and Annabelle Droulers here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.